Hello, everybody. Welcome to today's webinar brought to you by Bursa Malaysia. Our webinar title today is Income Without Surprises, Fixed Income ETF for Volatile Markets. My name is Shen Chu. I'm moderator for this webinar. Now, fixed incomes plays an important role, especially in portfolio diversification, risk management, and creating a more balanced investment approach. Today, we're going to delve deeper into fixed income as well as fixed income exchange traded funds. So before we begin, here is the disclaimer. Whatever we share in this webinar is only for educational purpose. So in no way that we give any recommendation for you to buy or sell any listed securities I mentioned here. If you decide to make any investment decision, you are solely responsible for all your investment risks. Now, today we are very honored to invite the head of investment specialist and research from AmFunds Management Berhad to join us in this session. So allow me to briefly introduce him. So Mr. Teh Chi-Cheun joined AmFunds Management Berhad in March 2025 as head of investment specialist and research. He brings 30 years of experience in the financial industry, including 20 years in funds management. In his role, he is responsible for managing the firm's outward communications, including the fund's investment capabilities, investment views, and product recommendations. He also oversees the investment research team, which delivers investment insights and recommendations across the firm. Prior to joining AmFunds Management Berhad, Chi-Cheun was the chief executive officer of a fund management company in Malaysia. He has extensive investment experience in global multi-asset strategies with deep expertise in equities and derivatives. He began his career in Malaysia and has also worked in Singapore and Canada before returning home. Chi-Cheun is a CFA charter holder and holds a Bachelor of Science in Accounting and Financial Analysis from the University of Warwick, England. So, good evening, Mr. Teh. How are you today?
I'm fine, thank you, Shane.
All right. So, we can't wait to learn from you about fixed income. So, take it over.
Okay. All right, let me share my screen. Hope everything is good. Let me start slideshow. Okay, I hope all of you can see my screen clearly now. And what
Yes.
I have here is actually today's learning journey. So basically, thank you all for allocating about an hour of your time this evening. And I hope that, when the hour is up, you'll be able to take some of these 6 things back with you. So basically here, I'm here to talk about bonds, fixed income, ETFs, and how they can support your investment goals. And we have broken it down into about 6 objectives. So the first one is about why income matters. So income is definitely a key component of any investment returns, all right? It is the cash in hand, cash in your pocket. So that's critical for many, many investors. And then for bonds or fixed income securities, I named this the Bond 101. In another field, I'll call it the basics of bonds. So how they work, the key terms that are used in the fixed income market. And of course, every investment has got its risks and returns. So here we'll explore a bit more on the risk and return drivers of bonds. Okay. And then we evolve and move forward to how fixed income exchange traded funds work. So the item 3 will talk about, 2 and 3 will talk about the individual bonds, and 4 will start talking about the ETFs and a portfolio of bonds and how they can actually provide individual investors with small bite sizes to be able to access the bond markets in an effective and efficient way. And 5 will be the various ETF strategies of bonds for different environments. There are many, many ETFs listed in the world, everything from equities to commodities to fixed income. So here it will be the fixed income strategies, the ETFs that are available for fixed income strategies. Okay. And then putting it all together, how fixed income ETFs can contribute to your portfolio. So the 6 learning outcomes here. Right? Now, why are investment returns important? Okay, so basically, if I go back to the very, very basics, okay, the total return from an investment. So when anybody invests, they want a return. So how do you actually assess the return? So there are actually two key components of total returns. Okay, the first one is capital appreciation. And everybody is very familiar that, especially in the Bursa Malaysia, when you buy a security in the stock market, if it goes up, that's your capital appreciation. So capital appreciation is due to price movement on Bursa Malaysia. In certain other markets, okay, it's just mark-to-market changes. Sometimes it can be driven by actual trade. Sometimes it can be driven by assessment of what the fair value is. All right. So generally speaking, for what we know, Bursa Malaysia or in any exchange, it's usually about price movement, actual trades that are done, and then you mark to market, and that's your capital gain, right? So my best example is Maybank. You bought Maybank at 10 ringgit, it goes up to 11 ringgit. 11 minus 10 is 1 ringgit. So your capital appreciation is 1 ringgit or 10%. But of course, with all investments, it can go up or down. Okay. So over the short period, it can be positive or negative. However, of course, when we invest in any investments, the objective is to ensure that in the medium to long term, they generate positive returns. So that's on the capital appreciation side. Then on the other side is actually the income. Okay. So income comes from various sources. Okay. So again, it can be the coupons from the bonds. Okay. Coupons are basically if you own a bond, it's the interest that you receive, okay, from owning the bond. Then of course there are profit payments from sukuk. Sukuk is as you all know, the Islamic version of bonds. And similarly, because they don't have the interest element, they have it as a profit sharing element. Dividends, we are all very familiar with dividends in the stock market. Going back to my Maybank example, if Maybank then gives a 4% dividend, okay, so that dividend will then translate, okay, into your return as well, right? And add to your returns. And then of course, you get all your fund or ETF distributions. So every year in end of February, early March, we all tend to look at what's EPF dividend going to be. For those of you who are invested in any of PNB's funds, be it for the Bumiputras, you have ASB, you always ask what the ASB dividends are for the year. Now, income provides that regular flow, okay, that's important for paying the bills and creates that visibility. Usually income is quite firm. You generally have an idea what you receive when you make the initial investment already, right? And of course, capital appreciation plus income gives you your total return. Now, why does income actually matter? Okay, so it is definitely one of the key building blocks of investment returns. All right, and in certain countries, income is actually very, very important because it provides stability and visibility. Okay, because as a business or you own a paper or you put your money in a bank, you know what the interest you're getting is, and that creates that stability and visibility. So I pull out a repetition from the previous slide of what income is. The four incomes are there. And why it matters, I say, is that it helps provide stability. It can reduce the short-term impact of market volatility, i.e. if the market actually has got a capital drawdown or you have a capital loss, the income can help reduce that loss, or even in some cases, the income can be large enough to actually offset the loss. All right. It also supports your financial goals. At the end of the day, although we can make money on capital gains, it's not money in your pocket unless you sell the security. So we have but at the same time, we all have our regular bills to pay, be it our electricity bill, for those who have a mortgage, your mortgage repayments that need to be made, and so on. All these bills that come to you, the regular income will help pay for these bills. It's money in your pocket to pay the bills, right? And ultimately, of course, with all investments, okay, fixed income exposure will actually improve your diversification, okay? And it can complement growth assets in a balanced portfolio, especially because we always talk about, a balanced portfolio, as there's always that mix of equity and fixed income, because the correlation between these two asset classes is generally very low, or even I would say easily half the time a slight negative correlation. So they tend to complement each other because diversification is really the only free lunch from investing. Right? So really in markets that are volatile, your income really helps you cushion, okay, the downside risk, and it also helps you reduce your reliance on price appreciation alone, right? So actually can enhance your return in certain environments. Now, going on to, again, this is where the 101 is, okay, or the basics of it. So basically, for any potential project or an entrepreneur, when he wants to do something, or a business, okay, when they want to build something and they don't have enough equity capital, for example, they don't have enough of their own money, they look to the market to borrow money. And there are two ways to borrow money. You go to the bank to get a loan, okay, or you can go to issue a bond, all right? So they all involve borrowing money, okay, to go to an investment, an underlying investment, okay, and repayment. End of the day, money borrowed must be repaid. But when it comes to a bank loan and a bond, the lender and the repayment structure can differ substantially, okay? So on the left is a traditional bank loan, all right? When you need a loan, you go to the bank and say that, look, I need a loan, and the bank lends you money directly. I mean, the best example many of us have is a mortgage. When we want to buy a house, we usually don't buy in cash. We pay the down payment, then we go to the bank and say that, look, I'm buying a house, I need a loan. So let's say your house costs, say, 500,000. Your down payment, say you give 100,000. So you go to the bank and say, look, I need a 400,000 loan. So the bank gives you the loan. And then depending on your period, right, be it 20 years or 30 years, you pay back interest with principal repayment to the bank, right? So the terms are agreed directly between the borrower and the bank. Okay, so here the bank is the lender of the money, right? In a bond format, instead of the bank lending the money, it's the investor that lends the money. Okay, so you actually lend the money, okay, by buying the bond that's issued, all right, by the entity that's issuing it. So it's usually a government, a company, or any other entity. And the issuer will pay regular coupon payments. The coupon payments are the equivalent of the interest paid, okay, and repays the principal at maturity. All right. So what happens is that in this case, you get the coupon payments, but at maturity, that means when the bond matures, you get the lump sum payment. All right. Unlike the bank loan side, where you normally have to repay interest with a certain amount of principal. All right. There are some cases in a bank loan where it's only interest only, but really in Malaysia, we barely have that. Okay. You normally have interest and a principal repayment, right? So on the bond side, again, so what happens is that the investor provides the lending to the borrower issuer. Then the borrower issuer actually issues the bond. The bond is actually effectively a piece of paper. It's like an IOU paper, okay? And on a regular basis, the borrower will give or pay coupon payments to the investor. Traditionally, it's half yearly coupon payments, and at the maturity of the bond, the entire principal amount, right? Now, bonds can be held directly. That means if you are a very, very large investor, you can go and buy the bond directly, all right? In Malaysia, for example, on the non-govie side, okay, the board lot size is 5 million ringgit. So if you have 5 million ringgit, you can go directly and buy a company bond itself, all right, in the market. Or you can do it through funds or ETFs. So here, basically, like I said, as an investor, you become the lender, all right? And your right to the lending is in the form of a bond, which is an IOU, all right? So the bond is essentially a loan, all right? But instead of the entity borrowing from the bank, okay, the issuer or the entity raises money from investors and pays the investors instead of the bank. So that's the bond 101 here. Now, go on a bit further. So, like I said, it is essentially a loan and IOU paper. All right. So this actually shows the sequence of how the flow is. So as an investor or lender, you provide the capital and you lend money to issuer or borrower, who then uses the funds for its, either working capital needs, a new project, or just to grow its business because it is to hire people, for example, is to have more stocks, okay, to build up inventory to grow the business. And then the issuer or borrower will definitely pay, okay, coupon payments or the income to the investor. And, okay, at the maturity of it, of course, okay, they also have to repay back okay, the principal, right? So the idea is that as an investor, okay, you lend the money today, the issuer will pay you income, okay, throughout the period of the bond's tenure, and at maturity, you get your money back, all right? So the examples of issuers mainly are governments. Governments issue bonds mainly because of infrastructure spending. You know, for example, if they need to build in a developing country where they need to build roads, they need to build the power grid, they need to build even the simple sewage system. Okay, so the governments will issue debt for that. Central banks also issue debt. Okay, there are certain reasons why they do that to help sometimes fund the government, or sometimes they even do that just to provide liquidity in the market. The best case example of providing liquidity in the market is Singapore. Well, until recently, they always had budget surpluses, so they didn't actually need to raise any debt. But because they want to create a debt market, they actually issued debt. Okay? Of course, corporations always are looking for capital. They normally raise capital through either debt or equity. So after equity, when you look at debt, they can either go to the bank to borrow or they can issue bonds. And of course, within corporations, there are also financial institutions which borrow because they're actually tier one capital and various capital requirements for financial institutions driven by the Basel regulations. So they tend to they issue bonds as well. And then, of course, you get the supranational organizations. These will include, many of the large government-linked entities. For example, you have in Malaysia, we have examples of perhaps you could say PNB, PWAP, okay, PTPTN, and so on. Okay, so these are the ones that actually issue such bonds as well. Of course, it's important to note that the bond investments are subject to interest rate risks. That's the key risk that affects them. And if the issuer is, a non-government, is subject to credit risk as well. And as always, depending on the nature and timing of the market, there's also this aspect of liquidity risk, okay, depending on where the buyers and sellers of bonds are and how active they are in the market. Okay, so these are some of the terms of bonds that are important, okay? So the principal of face value is basically the amount borrowed by the issuer and it's the one that's typically paid on maturity. So as I say, it's an IOU paper, and the paper was, and on that paper will say that this paper is worth, say, 10 million ringgit. So that's usually the amount that's paid on maturity. Of course, on that paper as well, we have the details of what the coupon payments are. So other than the principal amount, so what is the regular income that is being received by the investor or the regular coupon that's being paid, okay, by the issuer to the bondholders? And there's the maturity, there's the date when the bond matures, where the principal is to be paid. Okay? Now, the 4 and 5 are quite unique to the bond market because one is yield, okay, item 4 is yield. It's actually the return an investor may receive based on the bond's price and the coupon payments. So the bond prices can also move, but the coupon payments are generally mostly fixed already. Okay, in some cases, for some bonds, the coupon payments may be a bit flexible, but generally coupon payments are fixed. But because the bond prices can go up or down, but the coupon payment is fixed, so the yield you get, that means the coupon over the bond price, that's the yield, may change, okay? And that's important to you, the investor, if you are going to buy a bond, right? The duration is a very specific bond term, okay? It's basically a measure of how sensitive the bond's price is to interest rate changes, okay? So if I go back to my yield example, the bond price may move up or down. Now, a bond price moves up or down usually depends on the interest rate changes. And if the interest rate changes, how much does the bond value move? That's how duration is. It's a measure of that. For those who are in the fixed income world or starting, it's a weighted average maturity of the bond. Okay? And ultimately, of course, there's a credit rating. So this is an indication of the issuer's credit quality, basically how strong the cash flow is to pay the coupon payments and the principal. Okay, to basically its ability to meet its payment obligations. So governments and are basically deemed to be the best credit rating. They're sovereign debt. So basically, more if you are residing in a country, okay, or as citizens of Malaysia, we tend to view Malaysian government debt, as a sovereign nation. So really, the credit risk is near zero. All right. So, but as for certain corporations, some of the stronger corporations they have a better credit, higher credit rating, and of course, those that are in a more risky business have a lower credit rating, right? So that's how that's the credit rating. So each bond that's issued has got its own characteristics and its own terms. So you must make sure that if you actually go directly into buying a bond itself, if you buy a bond directly, please make sure you explore and read those terms and you compare them as well and make informed investment decisions. Right. So that's the bond side, the individual bond side. So now we talk about interest rates and its impact on bonds. Okay. So interest rate and bond prices are inversely related. So if interest rates go up, bond prices will go down. Okay. So for example, in the left here, when interest rates rise, okay, new bonds will offer higher yields. All right. That means if somebody issue a bond today, okay, when interest rates have gone up already, okay, they have to offer the new interest rate or the new, which will translate into a coupon payment. Therefore, the existing bonds that are in the market would see their prices fall, right? Basically, for those who are more astute, it's basically a cash flow. Okay, you just measure the cash flow, and to ensure that when you actually do the cash flow and you do your present value of the cash flow with the latest interest rates, that's where you get your bond price. So effectively, when interest rates rise, okay, your bond prices will actually come down because your present value of the coupon payments actually come down as well. And of course, the larger the change in interest rates, okay, the greater the impact on bond prices, generally speaking, okay. So of course, conversely, when interest rates fall, okay, bond prices will go up. All right. So the new bonds that are issued in the market will offer lower yields, lower coupons. So the existing bonds become more attractive, and then the prices will rise. So this is actually very important. So end of the day, just take away from this is that when interest rates go up, bond prices go down. When interest rates, okay, when interest rates fall, bond prices go up. Okay, that's as simple as it is. Okay, so this is measure of sensitivity. Okay, so we all get these measurements of the duration of the bond. All right. So for example, okay, if you say a bond has a duration of 5 years, okay, there are of course ways. There's a method to calculate duration. These days, not only Google, but with AI, you can get the calculation of a bond's duration very, very quickly. Uh, Even the bonds that are already issued, you just need to plug in the details of the bond and they tell you what the duration is. So if they say the duration of bond is 5 years, generally speaking, when interest rates rise by 1%, okay, the impact on the bond is minus 5%. So it's 1% multiplied by the 5 years. So 1% multiplied by 5. And then, of course, you put a negative in front. Okay. So because remember when I said interest rates go up, bond prices go down. So if interest rates rise by 1%, if a bond has a duration of 5 years, the estimate price impact is that the bond price will go down 5%. Similarly, or conversely, if interest rates were to fall by 1%, the price of the bond would increase by 5%. Okay, if it has a duration of 5 years. So that's why when you see a lot of reports on bonds or bond portfolio, they always make a statement, what's the duration of the portfolio of the bond. So that's important, okay, to look at because that measures the sensitivity to interest rate changes. So the higher the duration, obviously, the more sensitive it is to interest rate changes, right? So that's why when you find that when people expect interest rates to fall, okay, they tend to buy longer dated bonds so that the duration is higher. All right. So if you have a duration of 10 years, for example, and interest rates fall by 1%, you get a 10% positive upside. Similarly, when you expect interest rates to rise, you want to shorten your duration. Right. So that's how it actually works. Of course, this is a very simplified example, and you need to factor in actually the entire yield curve first, okay? That itself is, you could say, another chapter of earnings of fixed income. And then if you go into credits, basically you move away from sovereign debt, you still got to measure credit spreads. And then there are also aspects to look at about inflation expectations and liquidity as well. All right. Generally, inflation expectations will be factored in the yield curve already, but sometimes if you go off the uh, the 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 main tenors that are traded, the inflation expectations might not be factored in very well. Right? But then the key takeaway here is that at the end of the day, duration helps you understand the interest rate sensitivity of any single bond or a bond portfolio. So to wrap it up again, single bond, okay, you can find the duration, and the duration, which is number of years, is a measure of how sensitive it is to interest rate. In a portfolio of bonds as well, there is also a duration, okay? It's a weighted average duration of all these individual bonds. So you get duration of the portfolio. And again, that's how sensitive it is to interest rate changes, right? So key thing important is one of the most important things from this lesson is on this slide. And then of course, there are also several key risks and factors to consider, all right? So I said the longer the duration, technically the more risk you're taking, because the longer the duration means as the interest rate changes for an X amount of interest rate change, the longer duration, the higher the impact on the bond price. So risk is actually higher where your duration is higher or is longer in terms of years, right? And of course, there's always changes in interest rate. Risk is the most important change. Now, credit risk as well is something that's important because in times of stress or during economic recession, when the market or investors believe that there are more chances of companies going or being liquidated or going in to get into trouble, they will increase the credit risk charge. That means the credit spread will definitely increase. Okay, so that's where you have to be mindful of. All right, and of course with corporates as well, there is the credit risk because at the end of the day, when corporates do go into business, a business is a risk in itself, and they may not be successful in the business. Okay? Inflation risk, okay, inflation is something that is usually priced in the market already, but the challenge with inflation is that a lot of inflation today is actually mainly driven by energy prices, and energy prices can be very volatile. Okay? If you look back at history, you can see the long-term trend of energy prices, but in the shorter term, okay, we have seen what the US-Iran war has done. It pushed prices of oil and energy all the way up, WTI above 100, and that's why there's an inflation spike. Oil has since come down from above 100 to below 100, and the inflation expectations are reduced. But again, of late, because of fears that a deal can't be struck, oil prices have gone up again. Okay? Liquidity risk as well. So as always in all markets, there's always that liquidity risk. So the bonds that are the non-standard what I call or the tenors that are not frequently traded are normally have are normally have normally have a higher liquidity risk because there are fewer buyers and sellers. All right. And so some of them will also have a situation where really, if you really need to buy, okay, you really have to bid up for it. Or if you really need to sell, you really need to push down the price. Okay, because there are just no buyers if you really need to sell. So unless you get it, you offer it really, really at a good price. That means you have to expect less for your bond, then only the buyer will appear. And of course, for those of you who are in international bonds, please be aware of foreign currency risk and how it affect your portfolios. And ultimately, there's always the policy and market risk. So if the market suddenly just decides, that it is concerned about longer term inflation, which has happened in the US, you just see the long end of the curve go up. Okay, that means the longer dated interest rates go up, which means the bond prices will go down. Similarly, economic data, because people believe that economic data is an indication of how the economy will function, and today, more importantly, how central banks will react in terms of setting the policy. For example, everybody's watching the Fed these days, and the market has moved tremendously from cutting rates. You talk about, like 9 months ago, people are expecting them to still, the FOMC to still cut rates. Then, with the war happening, investors expected the FOMC to raise rates as much as 3 times, but today the expectation is only for one rate hike this year, and that's it. So that's what we call the policy risk of it. So bear in mind that fixed income investments are definitely not risk-free. Okay, the risk is a lot lower than equities, but it's not risk-free, and you have to understand the drivers, behind fixed income securities and the risks that they have. All right. So going on from the individual bonds to fixed income portfolios. Why portfolios are important is because for most investors, unless you're an institution and can buy, like I said, the board lot size of a corporate debt in Malaysia is 5 million. To have a diversified portfolio, as always, you need at least 20 names. Okay? 20 names, so 20 times 5 is 100 million ringgit. So how many of us can actually have 100 million ringgit just for a bond portfolio? It doesn't happen. Okay. Then what about your other investments as well? So that is why a portfolio, a bond fund, or an ETF allows you to have access, to a portfolio of bonds in a very small bite size. Okay. And again, you need to reduce concentration or you need to diversify. As I always mention, diversification is really the only one free lunch. So not only should you diversify across asset classes, within the same asset class, diversify as well. And a fixed income portfolio will give you that diversification, right? The only aspect where some people would argue that you don't need to diversify fixed income is if you hold sovereign debt. That means, let's say, as Malaysians, we just hold a Malaysian government paper. And here you can potentially hold just one paper, okay, if you believe in the government. Okay. But generally speaking, diversification is the only free lunch, and you should diversify even when you hold any asset class. Right? And of course, when you have a diversified portfolio of bonds generally pay coupons twice a year. So depending on when they are issued, you can just stagger it as well. Some can even pay in the off months like in February or in March. So with a portfolio, there's always income flowing, to the portfolio literally throughout the year. Okay. And even within the bond portfolio, because remember, most bonds, they pay you the principal and maturity, is one lump sum. So when you have a portfolio, it actually diversifies that, and broadens it out. Rather than you expecting the income, you get the income for 5 years, for example. Then suddenly at the end of 5 years, you get a big lump sum and with one paper, and you don't know where to invest it after that. So a portfolio, it takes that away. Okay? And of course, you have the maturity diversification as well. So you get to tweak around what you want your duration to be as well. Within a portfolio, you can do that, right? So you have some portfolios, you go to various funds, they say that this is more of a longer duration type of portfolio or shorter duration type of portfolio, right? In Singapore, for example, they have a lot of short duration bond funds of late. And then, of course, it allows you ultimately to have a portfolio approach. So everything can be adjusted. So across funds, you can see that you can have diversification within credit qualities, sectors, and even your market positioning. So within the bond space as well, there are many portfolios, funds, and ETFs. And for an investor, you can choose which ones you want to exposure to as well. Okay? So this is where the portfolio approach always actually makes sense. So this shows what it is about the characteristics of the individual bond. Okay. So really, if you get individual bond, just one issuer, all right. Actually, I should have put that number of 100,000 should be at least be 5 million for Malaysia. So you have single exposure risk. Okay. So there's really high concentration risk, especially if it's a credit paper, it's a creditless. So, like, even though it's deemed to always a safe company, you never know what's going to happen. All right. Okay. And then of course, there's a one set, coupon and maturity. Okay, you know that it's twice a year, so probably end June and December. You don't get a range throughout the year. And when it matures, you get a one lump sum back. Okay, was really, really one-off. And of course, you should have at least that 5 million ringgit, okay? Requires a larger capital amount. If you want to diversify, at least 100 million. Okay? And because it's a single paper, depending on what you buy, and at certain times, the liquidity may not be there, right? So really, really be mindful of the risks, which I reiterate again here, okay? Interest rate risk, credit risk, the credit spread risk, inflation risk. There's also liquidity risk. If you're going to foreign side, the currency risk, and of course, the policy and market risk as well. Okay, so really, when you talk about ETFs, exchange traded fund. So bond ETFs are now very common in many markets in the world, especially the US. And it is a fund, but it's a fund that's listed on an exchange. So you can buy and sell it like any stock. Okay, so it allows you the access, it allows you that market access and that ease of purchasing it. So it actually gets to provide investors with diversified exposure, transparency, and trading flexibility at the click of the mouse, just like you to buy a stock today. You can actually buy a bond ETF literally at the click of the mouse today. Okay, because of the nature of the market and the efficiency of exchanges, a lot of issuers in the world, a lot of fund houses in the world have actually moved to ETFs rather than funds. Okay, and of course, being a fund, okay, it gives you diversified exposure across many issuances. Uh, there is actually has a portfolio approach, and there are so many ETFs, bond ETFs in the world that gives you various types of flavor depending on what you like. Um, being an ETF, you only pay the exchange fees and the brokerage commission, which is actually usually very, very low. And of course, it gives you better liquidity because it can be traded in bite size, right? So in Malaysia, for example, you just need to trade 100 units. Okay. So really, in terms of multiple risk, if you buy a bond itself, it's in 5 million buckets. Okay. Okay. So it gives you that kind of exact amount that you want, okay, in terms of liquidity, and it's tradable as well. And of course, there's transparency, okay. As always, with all the reporting, you can see the holdings and you can also see the index and strategy information. So really, for fixed income ETF, you actually combine the benefits of a diversified bond portfolio of fund with the convenience and flexibility of trading on an exchange, okay, like any other security. That's the key difference with a bond ETF and a traditional bond fund. Okay, so really benefits of and flexibility of ETF trading. Again, the actual underlying ETF itself is a fund and it gives you diversified exposure. Exchange traded access. So when the exchange is open and trading, you can buy and sell very easily, very freely. There's much lower barrier to entry. So I said in Bursa, it's 100 units. In many of the global markets, you can actually get in with as little as even 100 US dollars, right? And of course, because of the bite size, it gives you that portfolio flexibility. You can also have a variety of bond ETFs globally. And if you look at a bigger context of a portfolio, when you do a portfolio rebalancing, you can do the trades very quickly and very efficiently, right? And of course, bonds always give you the income potential. They're still always there. And the bond ETFs will usually also give you a distribution. And there's always transparency as well, okay, in terms of the reporting, the trading volumes, and what they hold. Okay. So really, in Malaysia, there is one large ETF. Okay, it's the ABF Bond Fund ETF. Today, it's got 1.8 billion ringgit under managed in the ETF today, and it was actually the first ETF in Malaysia when SC and Bursa actually came up with the guidelines back in 2005. So when they came out the guidelines, about 3 months later, this ETF was launched. And it has a very, very decent track record. Size is there. And of course, it gives you a decent yield. Okay. It's got a very income-focused capability and it's managed by an experienced team. Okay. The largest, I would say, commercial bond house in Malaysia. And generally focus on generating regular income through a diversified bond portfolio of government and quasi-government debt and they also do active risk management. So really, there is this avenue in Malaysia itself. All right, we have one large bond ETF. Yeah. Now, when you extend yourself globally, okay, you find that there are actually bond funds and bond ETFs that can match various environments. All right. So, um, in terms of the market environment of rising interest rate yields, okay, what it means is that the new bonds will offer higher yields, existing bond prices may come under pressure, and as I mentioned, this one where you want shorter duration. Okay, so if you go across the region, and Singapore has got quite a few of them, they have many short duration bond funds. That means they try to keep the duration to 2 years or less. Okay, so they are less sensitive to interest rate increases. All right, but give you a decent yield. Similarly, in a falling interest rate environment, you want longer duration exposures, so you can look for those longer duration bonds. Okay, and in times when you talk about credit uncertainty, we want to have a quality focused exposure. Get the ETFs with a government or quasi government debt. All right, and then of course, if you need for search for income, okay, in a low growth environment, you should look for income concentrated strategies. So this is where you can look for the corporate bonds, which gives you high income potential. Basically, you look for those which generally have an underlying business, which throws out a lot of cash that you can then give you that kind of return. Inflation concerns, okay, this is all partially linked to the first point, rising interest rates. But in certain countries, especially actually it's mainly the US, they actually have the inflation they have the inflation protected bonds or the bonds that adjust themselves to inflation. So there are those ETFs listed, and really in this aspect, the bond coupons will be adjusted based on the inflation of the country or the inflation basket that they use. So that's actually an effective tool as well when you want to hedge yourself against inflation. So within this space as well for bond ETFs, you have ETFs that can match your concerns or match your view of the fixed income market. So really, how it helps? How does fixed income ETFs or fixed income funds help? Okay, basically, when people talk about diversification, it is really the only free lunch. So it's part to me as a core allocation. All right. The question is what kind of ratio you want. If you're more conservative, you want more in fixed income. More aggressive, you have less in fixed income. Then the question is that which are the other risk assets that you want? And that's a whole spectrum, ranging from equities to commodities to even the private market space. And of course, fixed income gives you that stability of income. That's why it's called fixed income to begin with. So it's a regular potential payout. And of course, you can always go defensive by nature of the market, because fixed income is lower risk. When there's a risk off approach, there's always a flight move to fixed income securities. And within even the fixed income securities, you can focus on the government debt. And then, of course, there's always the tactical allocation depending on the view that you might have. All right. So if you believe there's a temporary risk-off approach, okay, risk-off time, let's just say you expect US to launch another attack on another country, you might just say, look, I want to go to bonds temporary first. Or you believe that because of the budget or the new government in a certain country, okay, that they are going to spend a lot of money, there could be issues on the credit quality in the country, then you can have a specific ETF that focuses and can then address your view and allow you to invest based on your view. And of course, always with portfolio enhancements and diversification as well, it can fill in gaps in existing portfolio and generally enhance the overall efficiency of the portfolio. Here by efficiency of portfolio, it's like the benefits of diversification, okay? The liquidity of the portfolio, okay? How nimble you are, and of course, then how you actually ensure that you get your optimal returns based on your needs or your client's needs. Right? So again, just to sum up, so really, income is an important part of returns, and bonds can provide income, but bear in mind that they are not risk-free, and the prices move with changes in interest rates. Right? So when interest rates go up, bond prices go down, right? And vice versa. And then of course, when you look at the risks aspects of a bond: in duration, credit quality, inflation liquidity, and currency exposure. And of course, really for any portfolios, diversification. So a bond fund or ETF provides that bond diversification, and there are different strategies for different environments as well. And of course, the portfolio allocation should ultimately be aligned with your own objectives, your investors' objectives, risk profile, and time horizon. So that's the end of my session, and I think I'll pass it back to Shane.
Thank you so much for Mr. Teh for sharing with us about fixed income and also fixed income ETF. I guess the session here is very comprehensive. I think it covers almost every aspect that we need to know about Bond 101. So thank you so much to Mr. Teh for sharing with us with very such an enlightening session. So if you have any question to ask our speaker, you may write them at the Q&A box. All right, so the first question here I see on my screen is, Mr. Tay, so how do you see our Bank Negara interest rate movement in the next few quarters?
Oh, okay. Okay. The OPR, the house view is that we expect OPR to be maintained, so no change. Now, there are actually two reasons. Okay, if you look at the history of Bank Negara, they generally don't want to move interest rates too much because it's a broad-based approach. It affects everything across the board. In the past decades plus, since the global financial crisis, they always preferred more, you could say, targeted approach if there are inefficiencies in the marketplace. And now they're maintained at 2.75%. We expect them to maintain. Now, previously, people were half expecting them to actually cut rates because of the war, but you've seen some of the GDP, you've seen our GDP numbers that come up, which is very, very strong. So really, we are benefiting from the China plus one. We are one part of the plus one, okay? And we have seen that growth coming in. And on top of that, we are also shielded from inflation because of our Budi 95. So there's no reason for them to actually raise rates when we can still get petrol at 199 at the pump. So really, that's how inflation is quite well contained. Okay, so really, the view is that it'll be maintained, and ultimately, if you were to overlay that with and I think you can find it nowadays, with AI and Google. You've seen what the last two recent elections have shown. So there's no reason to rock any boats at this juncture. So that's why we have used that it be maintained.
All right, thanks for sharing your perspective with this issue. So the next question is from Mr. Kelvin. Can buying into both treasury bonds and inflation-linked bonds within portfolio diversify against both upside and downside risks of interest rate?
Technically, okay, upside and downside risk of interest rates. Okay, now inflation-protected bonds normally adjust for inflation. Okay, so far, the biggest market for inflation-protected bonds is actually a US market. There's actually an ETF on it. I think it's been around for a while, the Vanguard ETF. Okay, you don't have it in Malaysia, just to clarify that. Okay, so the short answer is that it actually measures against inflation. So it protects you against inflation. Now, does it actually protect you against interest rate risks? The short answer is not exactly, because if the Fed does cut rates, you actually find that the bond prices will still weaken. Okay, but at the same time, we haven't really seen an era of negative inflation in the US. So while you see that in the short term, when they first cut the rates, if it's not expected by the market, you'll find that, sorry, if the Fed does raise rates, you'll find that, okay, cut rates means the bond prices will go up, so you're fine, no problem there. If they were to raise rates, that means your bond prices will go down, but because they normally raise rates because of inflation, so that will be offset by your increased coupon payments because they're inflation protected. That's the idea behind it. So even though your capital value were to come off, your coupon payments were to go up because of inflation protectors. That's how they work there. So short answer is that it doesn't work. It doesn't work directly, but indirectly it does. Because at the end of the day, what's the Fed mandate is about, one of the mandates is against inflation. So when you have an inflation protected bond, it will offset that. That's the
Right.
best way I can explain it, okay. But really it depends on the nature and the exact time. So really very short term, you don't see it. But once you extend it out to about 9 months, you definitely see that is actually quite okay.
All right. Thanks, Mr. Tay. So the next question is about intermarket analysis. So if let's say Bank Negara maintain the rate and the Federal Reserve raise the interest rate by 25 basis point towards the end, so will Federal Reserve hike interest rate affect our Malaysian government securities?
Okay, the short answer is okay. People tend to look at the interest rate differential globally across markets because they say that sometimes depending because of the sovereign rating, okay, of the various markets. So yeah, and they use the US rates as the base because the global rating agencies are based there. But really, if you look at it, over the recent years, we have found that the correlation is there. Let's say the Fed does raise, or if the not so much the Fed, if the yield curve of the US yield curve actually rises, we will generally also rise, but not as much. If it's just the short end that goes up, let's just say the Fed raises 25, but the rest of the curve is relatively flat. That means the 5 to 20-year barely moves. We are generally not affected at all. So when you talk about the fixed income markets and the yield, if we actually look at the yield curve, so when the entire yield curve of the US actually moves, we are correlated to it, but not with the same extent. So we are, or in another perspective, we are a low beta play to the US yield curve. So for example, if the whole yield curve of the US moves 25 basis points, ours would probably be only like 5. Okay. So that's the entire yield curve. But if only the short end moves up and the long end, so it's like that, the short end moves up, the long end stays there, then we are barely affected actually. Because Bank Negara is probably not going to raise OPR. And our short end is actually anchored on Bank Negara's OPR. It's a
Right.
slightly different market fixed income, a bit harder for me to explain sometimes. In simple terms, I'm afraid.
Yeah, I guess most retail investor like us are more familiar with the equities market.
Yes, correct.
Yeah. So, but I think your session has been very enlightening so far, and it helped us to gain a lot of insights into the bond market. Right. So that's all the time we have with Mr. Tay today. So thank you everybody for tuning in. So let me share with you my screen. All right. So thanks so much, Mr. Tay, for sharing with us your insights.
Thank you for having me.